Did you know there are different levels of tax planning? That's why you may have experienced a tax surprise even though you paid for tax planning and you paid your estimated tax payments. Stay tuned. I will share the 4 main levels of tax planning, including how they affect your cash flow. So the first level of tax planning it's the basic level where your tax accountant calculates the minimum amount due, so that way you do not owe penalties to the tax authorities. So the IRS requires taxpayers to pay at least 90% of the current year or 100% of the tax shown on the prior year, whichever is smaller. This is the simplest version of tax planning, where the taxpayer is encouraged to pay 100% of the prior year. Done. Easy peasy, not much else to it. So here's an example. If your prior year taxable income is $35,000 at the 30% tax rate, your prior year tax is $10,500. Your tax accountant will give you estimated tax vouchers that total $10,500. Now, this level of tax planning, it does help you eliminate tax penalties, but it does not reduce financial surprises. The problem with relying on this tax planning method is you'll most likely experience tax surprises because the calculation does not consider changes that the tax accountant knows are guaranteed to happen, let alone what's going on in your business during the current year. So this leads me to the tax planning level number 2, where we consider the adjustments that we know are going to happen in the business. The most common example of this is related to depreciation expense. The Section 179 deduction allows 100% of the purchase price as a deduction in the first year. So year 2, year 3, all the remaining years, you've got 0% deduction. So even though the tax accountant is not aware of what's going on in your business the current year, they know that this is going to have a big impact on your business, your taxes, because this is guaranteed to happen. We know it's going to happen. 100% in the first year, 0 in the second year. And so this can have a very big impact on your cash flow and your income taxes that are due. So here's an example. Your prior year taxable income is $35,000. We're going to add back the depreciation, the Section 179 that was claimed. And so your adjusted prior year taxable income is $100,000. Now, this is nothing else changes in your business, only the change of Section 179 depreciation. So your estimated tax at that 30% tax rate is $30,000. Now look at the difference. Tax planning 1, just to avoid penalties, you're told you need to pay $10,500. But based on the information that's already available, we know that $10,000 is not true. You're really going to owe at least $30,000. This is where tax surprises happen all the time. Now, the good thing is you could still pay the minimum $10,500 through the estimated tax process, but you can plan for, you can save that additional $19,500, so that way you're reducing those financial surprises. So this level of tax planning, it does help eliminate tax penalties. It does somewhat of a decent job of reducing financial surprises. It still doesn't eliminate them because it still does not consider everything that's happening in the business during that current year. So when you're thinking about these first 2 levels of tax planning, these are usually completed by your tax accountant when they prepare your tax return for the previous year, which could be March or April. That means there's not a lot of information available for the current year. So if you expect changes in the current year, I highly encourage you to consider level number 3. This is where your tax accountant reviews your financial reports and they estimate the annual tax income based on the big changes that you might have in your business. They're going to look at changes in assets and net income. And this type of planning is usually provided during November or December by reviewing the previous 9 or 10 months. Here's an example of what this could look like. Let's say that you meet with your tax accountant and your business has grown quite a bit. So your taxable income is $175,000. At a 30% tax bracket, you have estimated taxes of $52,500. If you continue to pay that $10,500, you're going to owe the difference of that $42,000. So you still could pay the minimum, avoid penalties, but you start making plans for how you're going to pay the difference of $42,000. It's best to start saving that money throughout the year. And the sooner you know that number, the better planning you'll be able to do. So this level of tax planning is great when your taxable income fluctuates from year to year because it helps eliminate the tax penalty, reduces financial surprises. It helps you consider the current year changes in your finances. The biggest problem is it does not include a tax strategy to help you save money. Have you ever sat back and wondered, am I really doing everything I can to reduce my tax bill? So this leads me to the fourth level of tax planning, the tax strategy. So with this level of tax planning, your accountant will run tax projections based on various scenarios. What if we elect S Corp status? What if we start contributing the maximum amount to a retirement plan? What if we borrow money to buy 2 new trucks by the end of the year instead of paying cash? What if we buy a competitor that will double our sales? This level of tax planning can be completed any time of the year because it helps you estimate how much tax you'll owe for the current year while considering the pros and cons of making big financial changes. This level of tax planning, it does help you eliminate the tax penalties, reduce financial surprises, consider changes in your finances. It helps you consider tax strategies to help you save money. But this level of tax planning and most other levels of tax planning, they do not consider the effect on cash flow. The focus of the conversation stays on how can I reduce taxes. When you're meeting with your tax accountant, it's natural to think about reducing taxes, but you've got to take a step back and really understand that the first one of your primary goals of owning a business is to never run out of cash. And so the secondary goal is to make sure that you are able to be mindful in your tax planning. So remember, cash management first, and then tax planning. So now that you know how much tax you'll owe, it's time to consider when to actually pay the tax. So we know that the minimum amount is $10,500. The projected amount that we're going to owe is $52,500. And so when do we actually need to pay the money? So you actually have at least 2 options. The first main option is you can pay the minimum of $10,500 through the quarterly estimated tax payments, save the difference, pay the balance when you file your tax return. This will help you avoid paying penalties while waiting until the last minute to pay the tax authorities. But beware, do not spend that money because April 15th is going to be very painful if you do. Option number 2 is you can go ahead and update the amount that you pay through the quarterly estimated payments. So that way you owe 0 with the tax return by matching the money coming in with the actual tax period that it applies. You'll be able to avoid paying penalties and stay off the cash flow roller coaster. Bonus, you'll be able to sleep well at night knowing that your taxes are paid and you're less likely to have those financial surprises. The bottom line is tax planning is a vital part of running a financially strong company. So when done correctly, you'll feel confident you're claiming everything you legally can without tax penalties or cash flow surprises. Thank you so much for watching. As always, if you've got a question, please reach out. I look forward to pointing you in the right direction.